Thank you very much, and I didn't know there were so many certified secretaries. So allow me to just thank the Institute of Certified Secretaries for inviting me to come and speak to you today on the topic of monetary policy strategies for macroeconomic stability under the broader theme of governance resilience in the face of economic crisis. So my presentation today, I'll try to be very brief. Perhaps there'll be questions and answers at the end, but I'll try to be very brief. And the outline of my presentation will be basically to cover recent global developments, very briefly, just covering developments in inflation and perhaps growth. And then I'll move from there, from the global perspective to the domestic perspective, and just look at what's happening in the Kenyan economy and focusing on the key macroeconomic areas, which is inflation. Then I'll also cover the growth and growth prospects, cover the balance of payments, and finally cover the fiscal position, what's going on with revenues, expenditures, and the government's plan for fiscal. Can you hear me? For fiscal consolidation. So I think with that, let me then start with the global situation. And I think, as you all know, the last few years we've had quite a number of global shocks, starting from the COVID-19 in 2019, starting in 2019. And as you recall, basically the world economy shut down. So this was quickly followed by the disruptions following the Russian-Ukraine conflict. We started in early of 2022, and the conflict that was expected to be finished really within a couple of months. But as you know, this is a conflict that has continued in 2011, 2015, and also 2022, which reflected sharp increases in food and fuel prices attributed to these global developments. Of course, in our case, the perennial droughts have also had implications on food production and prices. For example, food inflation rose sharply to 15.8% in 2022, following 2 consecutive years of drought in 2021 and 2022. So in terms of the mandate of the central bank, our mandate is anchored in the Article 231 of the Constitution and also Section 4 of the Central Bank Act. And this mandate is to formulate and implement monetary policy so that we can maintain price stability. A secondary but equally important objective and mandate is to ensure financial stability. So the CBK's monetary policy is designed to support the government's objective with respect to growth by keeping overall inflation within a prescribed target by the Cabinet Secretary for the National Treasury and Economic Planning. So every year, at the beginning of the financial year, we always get a letter from the CS Treasury telling us that this is going to be the inflation target for this year. Normally, our inflation target has been to target 5%, but plus or minus 2.5%. So it's a range between 2.5 and 7.5. And every time the overall inflation goes above the range of 7.5, we tighten monetary policy, and I'll come back to how we do it. But essentially, we are then required to be within that range. If the inflation rate is within that range, then basically you're doing okay. If it's outside that range, then you need to undertake some monetary policy, either tightening or loosening. So Of course, a low and stable inflation rate coupled with adequate liquidity in the market facilitates higher levels of domestic savings. And of course, as you know, for you to do any investments, you must have domestic savings. So that supports the government's objective of rapid, sustained, and inclusive growth, as well as creating employment. The Monetary Policy Committee of the Central Bank is responsible for formulating monetary policy, and the policy decisions are determined by global developments, the current domestic developments, as well as the medium-term outlook. The Monetary Policy Committee just the governor of the central bank is the one who chairs the Monetary Policy Committee. And this committee does not, there is a board, there's a central bank board, but this committee does not report to the board. This committee is supposed to really be independent. It should not be directed by anybody. It should look at the facts on the ground and decide whether they want to tighten monetary policy. And the Constitution actually does specify that no one can direct the decisions of the Monetary Policy Committee, so that there is complete independence in terms of this committee taking any action without influence. So just looking at developments in the global economy, and starting with the global inflation, that you can see that global inflation the headline inflation has actually been decelerating. Yes, so you can see headline inflation globally has been decelerating from the middle of 2022. And for example, if you look at the US, you can see the red line, maybe it's difficult to see, but you can see it's just been going down. So global inflation has been decelerating. The US inflation now is about 3.5, that's the latest figure that was reported for March. 3.5, and generally the US targets an inflation rate of 2%. So where they are is still above their target, and that's why when the figure came out in February, the inflation was 3.2, and then in March it came to 3.5, and that's why you heard that the Federal Reserve may even not lower the interest rates that it had been expected to lower in June, and might even delay the lowering of interest rates because the inflation rate in the US has increased. Now, the headline inflation comprises of three components. There's the core inflation, which is susceptible and responds to monetary policy. And there you can see on the right, that is the core inflation. And again, you can see that there's a trending, the core inflation is actually trending down. And in the case of the US, you can see that the core inflation is at 3.8. Yeah, the overinflation is at 3.5, but core inflation is 3.8, which means that the other food inflation and fuel inflation are actually pushing down, so that you get an overall inflation of 3.5 rather than 3.8. But essentially, core inflation is what responds to monetary policy, and the reason it has been sticky, it has not come down, is because the labor market in the US is extremely strong, and also service prices have also turned out to be quite high as well. In regards to fuel prices, you can see there the developments in we just looked at the Melbourne oil prices, and you can see that for the most of 2023, fuel prices were going up, and that contributed to higher inflation. And then beginning around September, October of 2023, we had also a very significant decline in fuel prices up to around the end of December, early this year. And since that time, you can see that there's been an upward trend in Melbourne oil prices. And this basically reflects three things. One is the increase in shipping cost because of the fighting in the Middle East and in a sense, the closure of the Red Sea near Yemen because of the Houthis' attacks. That has increased the cost of shipping of oil. And of course, without that increases, obviously, the price of oil. The second is that OPEC has also continued to reduce their production by 2.2 million barrels per day. And that goes all the way up to June of 2024. And we do hope that the non-OPEC producers, the US, Canada, Brazil, will offset that reduction in supply so that we don't have a continuing increase in oil prices. And indeed, in the last few weeks, we have seen a kind of a reversal of oil prices. And you can see at the very end where we moved from $91 per barrel to 86.5. The third element that is pushing up prices is actually global demand. We've seen some recovery in the global economy, and every time you have a recovery in the economy, obviously demand increases. People want to travel more, and therefore we see pressures on fuel prices. With regard to the global food prices, which is the chart on the other side, we can see there that food inflation has actually been negative, with the exception actually only of sugar. Sugar prices, for some reason, they have been very high globally, and of course also in Kenya. And in Kenya, that situation was exacerbated last year because of the closure of the factories in western Kenya. So the next graph is just a representation of the increase in global freight costs. You can see from March 2019, they increased quite significantly and then have come down. And you can see now since the war in the Middle East, you can see they have started to pick up from $1,000 to $3,699. This is for the freight rate index for a 40-foot container, but that has come down a little bit, and we hope that reduction will continue. With regard to global economic growth, we see the projections. These are projections that were put out by the IMF only last week under the World Economic Outlook. And you can see that in 2023, the global economy was expected and is expected to record a growth of 3.2%. And even for 2024, it's the same number, and also for 2025. So we don't expect global growth to accelerate, and we just expect it to remain at 3.2. However, obviously that is an average, and we see different prospects and different growth rates for different regions of the world. And of course, the United States appears to be a very strong economy right now. In fact, we have been revising the growth rate for the US has been revised since October, was revised in January, it was also revised, and then last week, again, it was revised upwards. And you can see the United States growth is supposed to accelerate from 2.5 in 2023 to 2.7, and then again, just to slow down to 1.9. The area that is really disappointing is the euro area, and there you can see that in 2023, in the euro area, growth is only expected to have grown by only 0.4. And you can see the reason for that is the German economy was actually contracting. And as you know, the German economy is the largest economy in Europe. So whatever happens in Germany affects, obviously, the rest of Europe. But the economy in Germany has been contracting. It contracted last year by 0.3, and this year we only expect it to increase by only 0.2%. And then again to recover somewhat in the next 2025. Of course, China, you can see China is also, growth has been also slowing down. And you can see it declines from 5.2 to 4.6, and then in 2025 to 4.1. And China is obviously going through some very difficult times. Their property market is really in really bad shape. The prices of housing has declined, and that has also led to a reduction in consumer confidence and reduced aggregate demand. And for the first time, you actually see the Chinese economy really growing at really low rates, 5.2, 4.6. There was a time we're used to Chinese economy growing at 10%, but that is no longer the case. But the one area that is really doing well is India. The economy of India last year was projected to have grown by 7.8, which is one of the highest rates. And then, and even this year, we expect India's economy to grow by a significant 6.8%, followed by 6.5. For Sub-Saharan Africa, there's a slowdown last year to 3.4, but we do expect some recovery this year to 3.8, and then some further recovery to 4% in 2025. Now, I want you to look at the very last row, which is the Kenyan economy. And just for purposes of comparison, you can see in 2023, we actually, these are actually the IMF numbers, 5.5. Our projection as central bank, we had projected 5.6. But in any event, you can see the growth for Kenya of 5.5 compared to the average for Sub-Saharan Africa, which is 3.4, compared to the emerging market and developing economies average of 4.3, and then of course advanced economies, which obviously you'd expect them to be a bit lower at 1.6, and the global growth of 3.2. And even going forward, you can see that the growth for Kenya is higher than for the average for the other regions. So relatively speaking, we are doing relatively well, but I'll come later to the to some of the details on the performance of the Kenyan economy. Now, on the financial side, we've seen that there's been an increase in risk appetite and a positive sentiment in the global financial markets. And you can see that even for the S&P 500, there's been positive growth since October 31, 2023 is an index of 100. So you can see most of the stock indices have actually been going up. And this is an indication also of positive investment sentiment, positive market sentiment. And again, the yellow line at the bottom is again China, just reflecting the problems that China has been going through. Now, because of this positive market sentiment, the international capital markets have begun to open up, and you can see that there's been an issuance of sovereign bond even this year, 2024, and these are the emerging markets that have issued euro bonds. And in the case of Africa, you see Cote d'Ivoire issued a euro bond in January of $2.6 billion. This was followed by Benin, which issued in early February $700 million. And then, of course, Kenya, we issued a euro bond for 1.5 billion in February. So just the key then takeaway for the global economy is that we see the global economy continues to recover, supported by rising demand, mostly in advanced economies, and strong growth prospects in emerging markets and developing economies. However, geopolitical risks do remain persistent. Inflation concerns have moderated, although some stickiness has persisted in advanced economies. The financial markets conditions have improved, supported by increased risk appetite, and of course access to capital international markets has also improved. And advanced and emerging market economies were expected to start cutting interest rates in the second quarter of 2024, although now, as I indicated, there are some doubts as to whether the Federal Reserve will lower interest rates. In June, they were expected to lower interest rates by about 25 basis points, but there are some doubts now whether they will do that or whether that will be postponed, and whether we'll only have two events of lowering rates by the Fed. And then finally, Kenya's real GDP growth is expected to remain above the global, sub-Saharan Africa, and emerging market and developing economies averages, mainly supported by resilient services and improved performance of the agricultural sector. So turning to monetary policy measures and outcomes. So to address the inflationary pressures that we have been experiencing, the central bank has tightened monetary policy by raising their central bank rate. And cumulatively, we have raised this rate by 600 basis points since May of 2022 to the current level of 13%. And these increases were essentially aimed to address the inflationary pressures, also the pressures on the exchange rate that we are experiencing, and to also mitigate the second round effects and ensure that inflationary expectations were well anchored. In the recent monetary policy meeting of April 3rd, we left the CBR unchanged because the Monetary Policy Committee felt that the actions that it had taken had indeed resulted in lowering inflationary pressures and to a certain extent addressing the exchange rate pressures, and also the inflation expectations were well anchored. In addition to that, the Monetary Policy Committee felt that going forward, that fuel prices will come down, food prices also will come down, and also the continuing impact of a tight monetary policy on the non-food, non-fuel inflation also would force the non-food, non-fuel inflation to come down. So really there was no need to tighten monetary policy any further, and that the existing monetary policy was sufficient for us to move towards the 5% midpoint of our target range. And of course, the CBK's monetary policy measures have been complemented by the policies of the government. The government has instituted zero rating on some food items, and this has lowered the cost of food. And of course, also the fertilizer program, the subsidized fertilizer program, has also resulted in increased productivity in terms of food production, and that has helped in reducing the prices of food. So this is just it's a demonstration of where we have been in terms of domestic inflation. Maybe just to look at the very beginning, you can see the three columns. The blue is the food inflation. The yellow is the fuel inflation, and the green, in a sense, is the non-food, non-fuel. And you can see that then there's a dotted line which shows you the combination of all those three, and that is the overall inflation. So just looking at the first three columns, you can see food inflation was 15.8. You can see fuel inflation was 12.6, and you can see that the non-food, non-fuel inflation was 3.8. And the combination of all that gives you the 9.6 that you can see there just in the middle. So, and then looking at the very end, again, the three columns, food, fuel, and non-fuel, non-food inflation. And you can see from the overall inflation, we have moved from 9.6 all the way to 5.7. And the question then is, what has driven this inflation down? Well, you can see that food inflation was 15.8 at the very beginning, and now it's only 5.8. So obviously that has had a significant impact on reducing inflation. Secondly, is the non-food, non-fuel, I guess responding to the tightening of monetary policy, that has reduced from 3.8, actually from 3.8 it went all the way to 4.4, but with the tightening of monetary policy, that has come down to 3.6, and fuel inflation has not changed that much. And you can see that in October it was 12.6, and right now, as of March, it was 12.3. We do expect going forward that there will be a base effect on fuel prices, because you remember fuel prices, the VAT on fuel prices was increased from 8% to 16% around July. So July last year, there was a significant increase in fuel prices. So by the time we get to July this year, just because of that base effect, we should see a significant slowdown in fuel inflation. So this is just a chart showing the contribution to overall inflation. You can see at the end, at the very end, with inflation at 5.7, about 1 percentage point came from non-food, non-fuel. 2.5 came from fuel, and the rest of 2.2 came from food. Quickly, this is the path for non-food, non-fuel. Again, you can see that it peaked around February of 2023 last year, and with the tightening of monetary policy, you can see it has actually been coming down, and now has broadly stabilized around 3.6 for the last 3 months, from January, February, and also March. With regard to fuel inflation, the three key contributors to fuel inflation are pump prices, electricity, and really transport. And then of course there's LPG, but the main ones are pump prices, electricity, and transport cost. And in March we did see a reduction in fuel inflation from 13.4 to 12.3. And this was primarily because of the exchange rate appreciation. I think for the first time we felt the full impact of the appreciation of the shilling on pump prices and electricity as well. Transport costs sometimes are difficult. Once prices go up, sometimes it's very difficult for prices to come down, but at least with pump prices and electricity prices, these are set, and therefore they can go up and down. But transport costs sometimes tend to be sticky. Once they go up, it's a bit difficult for them to go down. But yes, so pump prices, the reduction in pump prices and electricity did reflect the appreciation of the Kenya shilling. So in terms of expectations and what people expect going forward, we do take some surveys, and we did have an agricultural survey in March. We had a similar one for November. And essentially, the respondents, basically in November, we asked the respondents what they expect inflation to be in the next 1 month, and what they expect inflation to be in the next 3 months. And you can see that in November, 57% of the respondents thought inflation would increase in 1 month, and 60% thought inflation would increase in the next 3 months. But in the survey for March, you can see that has lowered significantly. So only 40% of the respondents thought inflation would go up a month ahead, and only 34% thought that inflation would go up within the next 3 months. So essentially, with expectations are that inflation will continue to decelerate and towards our target of 5%. So the takeaways here is monetary policy measures have lowered inflation and have addressed the exchange rate pressures. Inflation has decelerated from a high of 9.6 to where it is now 5.7, and we expect that to continue to decelerate. And this decline reflects the impact of monetary policy measures, the easing of food prices due to good weather, the adjustment exchange rate, the impact of the appreciation of the exchange rate on electricity prices and pump prices. And we do expect inflation to continue to decelerate in the coming months. So turning now to the domestic economy, as I indicated, that despite the multitude of global shocks and increased uncertainties, the Kenyan economy has remained resilient and is expected to remain above the global and sub-Saharan averages in 2023, 2024, and 2025, pointing to the resilience and diversified nature of the economy. We expect growth of the economy to be 5.6 in 2023, and we do expect this momentum to carry on over to 2024. And as we'll come and see, we are projecting a growth of 5.7 for this year. So this is just a depiction of the growth rates for each year. And you can see that in 2011, growth was 5.2. But essentially, if you take out the outliers, which is 2020 and 2021, 2020 is when you had obviously the impact of the COVID, and you can see the economy contracted by 0.3. And then there was a huge recovery the following year, 2021. So if you were to take out those two years, you can see, broadly speaking, the growth of the economy has been quite robust at around, basically around 5% over the last decade or so. So you may not be able to see those details, so I won't go very much into them. But essentially, this is a depiction of what is driving the economic growth. The first line is agriculture, and agriculture has recovered significantly. We are projecting growth of 6.6 in agriculture for 2023. This is one of the highest growth in agriculture we have experienced since around 2010, when growth was 10%. So the agricultural sector is growing very strongly in 2023, and we expect that momentum to continue to this year. So we expect growth of 4.9 this year compared to 6.6 last year. Services, the services sector, this is the middle line, let's say it's 2.2. Again, this has been very resilient. We expect growth of 6.6 in 2023, and we expect that to carry over to 2024 of 6.6. And it's really being driven by accommodation and food services, which is increasing very significantly. This is from tourist arrivals. For example, tourist arrivals last year was 31%, which is quite significant. And I think now we've gone even beyond the pre-COVID levels in tourism. but also the information and communication, that has always been a growth driver. Finance and insurance also has been a growth driver. So we do expect that going forward, the real GDP growth will continue at least by 5.5%. Our projection is 5.7 for this calendar year. This is just some examples of projections for agricultural production. Maize, 30%, wheat, 63%, beans, 81%. So, in short, the agricultural sector at the moment is doing quite well. Let me say something briefly about the balance of payments. The balance of payments obviously is what determines the outflows and inflows of foreign exchange through either trade or through the capital account, people investing locally or people investing outside. But essentially here we see that the current account is, for this year, we expect the current account of 4.8 billion. That's at the very end. We expect some recovery in exports, and also, and I'll come back to a bit of the details on exports. We also expect some recovery in imports. But the bottom line is, and I hope you can see the very bottom line, which says the overall balance of payments, and you can see at the very end a negative minus 1.35. Minus means you're building your international reserves. So essentially, our projections for this year, looking at how much we're going to export, which is an inflow of foreign exchange, how much we're going to import, which is an outflow. Taking into account all this, we expect an increase in our international reserves at the central bank by at least $1 billion. So this is the current account deficit of the balance of payments, and you can see that it has been narrowing. It was 5%, I think, in 2022, and then it narrowed to 3.8% last year, and now we expect this year for it to be about 4%. We think that 4% current account deficit is just right. It's a sustainable level of our current account, and really all we need now to do is to encourage foreign direct investments, so that it's those foreign direct investments, which obviously foreign direct investment is not debt. So, and if we can use the foreign direct investments to fund this current account deficit of 4%, then we'll be in a situation where it's a sustainable level, and it is not generating any debt that could cause our debt to move to an unsustainable position. So on exports last year declined from 7.4 billion to 7.2 billion. This is a decline of 2%. We have started to see a recovery in the first up to February. You can see the 12-month growth in exports is it's still minus, but it's a smaller minus than the 2.2. It's minus 1.7. For the year as a whole, we expect some recovery in horticulture. We expect some recovery also in tea, and overall, we do expect exports to grow by around 10 to 11% for this year, compared to the contraction that we experienced of 2.2% of last year. That's just a depiction of the details of the exports, but essentially most of our exports declined, except for the regional exports, and in particular cement. On imports, here you can see the imports declined last year by 10.6, and again, this was virtually every category of imports declined, with the exception of food. And of course, in the case of food, the government was trying to ensure that there was sufficient food, trying to address the issue of cost of living, and therefore did offer some tax incentives, including zero rating some food items, so as to lower the cost of living. And but nonetheless, the total imports declined by 10.6. And in a sense, this is what contributed to the significant narrowing of the current account deficit from 5% to 3.8. Now this year, we expect a reversal. We expect now to see imports increasing. Last year, you had the exchange rate had depreciated. Of course, that made imports much more expensive, so people didn't import as much. But now this year, with the strengthening of the shilling, we would expect an increase in imports, and indeed we have factored in an increase of imports by 11%. These are the details on imports. So one area that we think we are doing very well is on diaspora remittances. This has been a consistent source of foreign exchange for many years. Last year, we had an inflow of about $4.2 billion. This was an increase of only 4%, and I think this was really a slowdown. It could have reflected some of the uncertainties in the US economy. Most of our remittances, about between 55 and 60%, come from the US. So whenever the US is going through some difficulties, then we do see some response to remittances. Now, in our projections, the projection that I gave on the current account of 4%, we have assumed remittances this year will grow by roughly 5%. Yeah? So last year it was 4%, this year 5%. However, in the first 3 months of this year, we've seen the two columns at the very end. We've seen remittances actually growing by 18, almost 19%. Yeah? So if this pace continues, and really there may not be any reason why it should not continue, then we should be able to see really a positive shock to the current account. So instead of the 4% we're projecting, the current account may be even lower, and this will be again a significant increase in foreign exchange into the economy. On the issue of the reserves of the central bank, you see at the end of 2023, at the central bank we had $6.5 billion, and this has been steadily increasing, so that as of April 18th, we had $7.2 billion, and this was equivalent to about 3.8 months of import cover. This is just an indication of the current exchange rate developments over the last few months, and this really just shows you that there was before January 5th, we in a sense we had two exchange rates. We had the one in red was what we call the case one, which the Kenya shilling one, and this was the rate that we used to publish on our website, the central bank. Yeah, and it was basically an indicative rate. Banks would talk to one another and give indicative rates of what the bid and ask rate would be. But there were no transactions that would take place at those rates. The transactions would take place at the blue line. So that's why sometimes last year I used to hear, oh, the central bank is saying the exchange rate is 120, but when you go to the banks, it's 130. So that was the reason. But this year, in addition to many of the other reforms that we have implemented in the foreign exchange market, we unified this rate. And you can see since then, of course, with the issuance of the Eurobond and the infrastructure bond, you can see that the rate has, the unified rate has now declined from over 160 to 131.3. Okay, this is just, again, the same, but just a trend of the foreign exchange rate. Again, having reached a maximum of 160.5, has come down to 130 to a 130 range. Then, I think finally is on the fiscal performance. Though this is not my area, I would say that the government remains committed to fiscal consolidation, and this fiscal consolidation is very crucial for stabilizing our debt. And as you can see in 2023-2024, the deficit target is actually 5.5% of GDP, but this is the target under supplementary one. So I think anytime, suddenly, if not probably next week, we should expect the Treasury to submit the supplementary 2, possibly with a lower deficit than this. But the idea will be to have this consolidation, reducing the fiscal deficit over a certain period of time. Right now, our debt to GDP ratio in net present value terms is roughly about 68% of GDP. But Parliament approved the other day that we should not exceed, or we should target a level of debt to GDP of 55%. So this path of fiscal consolidation, or reducing the fiscal deficit, is consistent with reaching a debt to GDP ratio of 55% by the year 2027, 2028, around there. This is, very quickly, the impact of the shilling appreciation on our debt. And I think this is not really appreciated. It's not appreciated what the appreciation of the shilling has done to our debt. So looking at the blue lines or columns to the left, there we are showing actually the external debt. So the external debt in terms of converted into shillings as of end January, and you can see it was 6.19 trillion. And of course, domestic debt in shillings was 5.058. So add the two together, you get a total debt of 11.248, basically 11.2 trillion. Now, following the exchange rate appreciation, this is now calculated at the exchange rate of 131.5. You can see suddenly the external debt expressed in shillings has declined from 6.19 to 5 trillion. Yeah, that's a decline of at least almost 1.2 trillion. And of course, the domestic debt does not change. So that when you now add the two, our total debt is now at 10.1 rather than 11.1. So that operation had a huge impact on reducing our debt stock, and of course also going forward, it reduces the debt service in terms of shillings that the Treasury has to pay. So finally, just to summarize, that despite significant global and domestic challenges, the Kenyan economy performance has remained resilient, and the outlook remains strong. The CBK's monetary policy tightening has had the desired impact of addressing pressures on the exchange rate and also mitigating the second round effects and ensuring inflationary expectations continue to be well anchored. And finally, CBK monetary policy measures have been complemented by fiscal measures implemented by the government to moderate the prices of specific commodities through zero rating some food items, including maize, wheat, rice, and sugar, and enhancing food production through subsidy on fertilizer prices. So I think with that, thank you very much.